Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Today on the podcast, we have Jeff Adler. Jeff is a vice president of Yardi Matrix. Jeff is a board member of NMHC, holds an MBA from the Wharton School, and is a former chairman of the Urban Land Institute Multifamily Silver Council. And Jeff, you'll be happy to know we use Yardi at all of our properties. So
cool.
I think about 1,700 units.
Fantastic. Thanks. And thank you for your business.
Absolutely. Well, welcome to the show. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, sure. So I run Yardi Matrix, which is the data vertical and market research arm of Yardi Systems. But we have our own independent research staff where we have about 400, 500 people that are gathering data about multifamily properties. I also have an analytical team that is creating forecasts and other sort of analysis on top of that kind of underlying data. We also do work on the commercial side. We supplement the data that we collect. We have about 25 million or so units in the coverage universe. Anything over 50 units and about 190 markets, or about 370 sort of metro areas that cover about 95% of the US population. So we have a pretty decent handle on the market. We also supplement that data with actual transaction data, aggregated and anonymized, out of the property management system. So it's triangulation of what's kind of going on in the market. Before all this, I was chief operating officer of Aimco, the apartment REIT, from about 2001 to right around the GFC. So I've been around apartments for a while. I love them. I just love the industry. And I've been very fortunate to be able to do what we do with a great group of people, and to bring some value to the marketplace.
Awesome. Well, we appreciate all the data that you put out. I've been watching it for a long time, and it certainly helped me become a better operator and make better decisions. So thank you.
You bet.
So let's just jump into it. Where do you think, the broad question, where the multifamily stands today? Do you think we've hit like bottom and peak cap rates, or do we still have another year or so kind of working through those deals that have been extending and pretending?
Well, I think, I'll start this just with an understanding of fundamentals. And then from there, we kind of go into valuations and transactions. There really is this sort of bifurcation of what's going on, right? So we're still living through the aftermath of COVID. We're not done yet. So to really understand where we are, it kind of helps to just understand COVID and its aftermath, right? So if I can break this out into, remember, we had a massive inflation, a massive increase in the money supply, 25, 30%. And we also had a massive movement of people from some places to other places, mostly the Sun Belt, right? We had an acceleration of migration where in those Sun Belt markets, Sun Belt, Mountain West, we had a mass movement of people who had rents shot up like crazy. And there was a meaningful supply response because that's the nature of these cities. We had cheap money and skyrocketing rents. And so we have a lot of supply. That supply kind of got started in, call it 22, 23. It's begun to deliver. We still have this year to sort of work through the remaining kind of like surge before it stabilizes. And that's the writ large. So again, the Sun Belt is going through this surge of rents, and almost like around Austin's kind of almost like at a full round trip. Okay. And other markets, remember, rents should be up if they just stay with inflation about 25% from pre-COVID levels. So again, you kind of have this area where you're beginning to normalize. Okay. But the normalization and absorption of that new supply has been really pretty good. Okay. If you think about the wave of that new supply, and part of that is the fact that with interest rates high and home prices high, retention has been higher, or the other way to say turnover has been lower. And the increase and there's been an increase on those more leases that are renewing. Okay. Yes, there's negative lease tradeouts for new leases in the Sun Belt, but that blow has been cushioned to a certain extent because of the impact of renewals. And as a result, properties that were bought at the peak in that 21, 22 timeframe with variable rate debt that are experiencing the kind of declining, they've been slow to sort of like show up in distress sales. They're beginning to show up more. I mean, I am seeing more of them flow through, but it's like from a super small trickle to a little bit of a bigger trickle, as opposed to a flood. There is no flood happening, okay? But there is some more getting resolved because it's been a number of years since, again, if you bought at the peak with variable rate debt through a private debt fund, the pipers kind of come into call. Okay, but not every deal that's in those situations actually is going bad. We actually track the DSCRs of all those deals, so we know the candidate pool of the ones that are likely to go bad, but not many of them are, quite frankly. So if I think about this, again, I'll focus on the Sun Belt and Mountain West. We're in a place of kind of turning it around. So there's still in the first half of this year, rents in the Sun Belt did go down in most markets, but they went down less than I thought they would go down. Okay. So that's actually, and as we are updating our forecasts, what we're seeing is that while the shape of the curve of bottoming and coming out is still there, it's in most of the markets less shallow. It's more shallow than it otherwise would have been. So that's like, or less bad than it otherwise would have been. But there's this sort of like shape where it's like starting to decline, but it's declining at a slower rate. And then it'll hit bottom probably the end of this year, early next year. And then we'll see a movement on a sequential basis off of that. Okay. But you really don't get back to, I would call, normalization until, in most cases, mid-year 27, early 28. And what I mean by normalization is 2.5%, 3.5% rent growth on a sustained basis. Now, in the Midwest, their rents went up and they never went down. They didn't have as big a supply response. And so from this point, the supply response is happening. Columbus, Ohio is an example of a supply response that is happening, but it's not anywhere near the level of supply response that happened in the Sun Belt, okay, which you had something like 25% of the stock. And what's interesting is like the housing stock of multifamily is way newer, way younger than it was like 20 years ago. So there's been a lot of new supply added into that stock. And that has been a surprise, like 40% of the entire housing stock is what we call Class A. It used to be 20%. So there's a lot less traditional value adds there and more at the higher end. So you're seeing a bifurcation of markets where the Northeast and Midwest are actually been doing pretty well. Now you have San Francisco, which is like the AI recovery story. Okay. And in Seattle, you have the city of Seattle kind of has this political muck, but then you go across to Bellevue and things are doing pretty well. So it really is like this bifurcate. It's a bifurcation by geography to a meaningful extent, and then also the affordability issue that people do talk about is much more at the bottom end, I'll call it, of the K, okay? Because at the upper end of the K, rent to income ratios, which we get are in the 20s. Like, it's not a thing, right? Like, there's enough supply, there's enough people, they can afford it. At the bottom end of the K, okay, because you can't, because of restrictions in building and building codes and permitting and zoning, and you can't deliver inexpensive product at the bottom end of the sort of price point range. And as a result, those consumers are exposed to a higher personal rate of inflation, both in housing and in gas and in food, and their income to rent ratios that we see screened are higher, and there is pressure on those consumers. And so you have, sort of a tale of two cities by metro area, and you also have a bifurcation by consumer type. Okay, and we do collect now collections data. We're exposing collections data, and you do see that also expressed there. So, like, you're not getting the supply pressure at the bottom end of the market, but you're getting other problems at the top end of the market. You don't have collections problems, you don't have affordability problems, but you have to work off this supply but the reason that the supply is in fact being worked off is that because of high home prices and high interest rates, fewer people can or are able or want to, move out. So that's helped cushion things. So it's a very intriguing set of circumstances. I don't see interest rates going down anytime soon. In fact, on the short end, the pressure is to go up. On the long end, it's already gone up some at 4.75% as we sit here today. And inflation is not great. It's not horrible, but it's uncomfortably high. And the policy mix that was bringing inflation into the twos has been disrupted because of the Iran war. And so, is that a permanent? Is it short term? But it's disruptive. It's disruptive to the GDP numbers. And Gary, I can stop right here and you can ask me another question because I can tie all this stuff together and go on forever. But I should probably stop here before I just go to the rest of the go talk for another 20 minutes. But go ahead and ask me another question.
All right. So I'm curious if you have data on. So we're in the Tucson market mostly. That's the bulk of our stuff. And so what we're seeing, obviously, some self-deportation, and less foreign students at the university. Yes. And we don't deal with student housing, but there's a trickle-down effect.
Yeah, everything trickles. Yeah.
And I hear that from operators all over the country, not just states near the border or cities near the border. I'm curious if you have any data on that, how it's affecting demand for apartments.
This is a little tricky, okay? Because as you've kind of said, the surge in immigration, which was ahistoric and put tremendous pressure on housing markets, but most of those folks went into the informal market, right? Below 50 units, private landlords. However, it rippled through the marketplace, right? It had these knock-on effects. And so we don't have super great data on the folks who came in. We don't have super great data on the folks who are leaving and the folks who are not coming, right? So that's the other part of it. There's the folks aren't coming and some in fact are leaving. So that is loosening up the bottom end, like that informal sector is loosening up, but then it's leading to a loosening up everywhere. On the other hand, however, I want to be kind of clear, when you look at what we call rent by necessity properties, they very much follow the overall trend of the entire market. So, in Austin, right, there's been so much new supply at the upper end that the filtering effect is real. It has flowed through. Now, but on the other end, okay, in markets where rents are rising in the Midwest, they're rising more at the lower end of the product scale. So that would kind of tell you that it's more of a general supply story than it is an immigration story. Okay. Now that's why it's murky, right? It's like I can't put my finger on it exactly. It's got to have an influence, but in the kind of professionally managed 50 unit and above world of multifamily, it's a muted impact, is what I would probably say.
Yeah, and so for us, obviously we're back up to where we were in occupancy, but boy, there was this dip in there for a while, and it had to be, the burning off the supply, but certainly kind of a race to the bottom too, where we felt we had some superior product in some submarkets, and we're having to compete with you know properties that were just not nearly as nice, but it was kind of a race to this bottom number that people were chasing.
Right. Before it begins to bottom out and kind of turn around a little bit. Yeah.
So we're finally going to see some rent growth. They've been talking about rent growth for a while, and even now we see some predictions of maybe second half, but until we see it, I'll believe it. But
yeah, I mean, I think it's a question of what do you mean by rent growth? You mean by sequential rent growth, right? Do you mean, like, because and obviously the Tucson market sometimes is sort of not typical because it's so hot. You get a better winter, right, than you do get a summer, right? So most of the country's key leasing season is September through August, right? And then all the action is right there. But in Phoenix and in other very hot markets, South Florida, their big season is fourth quarter and first quarter, because that's just a different weather cycle. Okay.
Yeah.
But mostly what I think we'll be seeing is a slower rate of rent declines. Okay. As opposed to, again, if you're looking at we are seeing in most of the Sunbelt markets sequential rent growth. And in some markets, like 7/8 of a point. So there are markets that we haven't released our July report. I know it because I approved the report that's going to go out next week. There were some markets, in the Sun Belt that posted strong sequential rent growth, or very small declines, right? Which is encouraging in those markets. And then also decent growth in the Midwest and a strong growth in the Bay Area, particularly, which again is more sort of continuation of these trends. But overall, demand has been better than otherwise would have been thought of. Supply is still coming. We're not through that. We think the 26 will be about 490,000 total units delivered. So it's a big number, but that number includes market rate, partially affordable, and SFR BTR combined. We do think, and we're seeing a normalization of pure market rate down to pre-COVID levels, but it's these other sort of subclasses that are pushing the number up kind of as high as it is. And we do think that supply nationally levels at around 450. Okay. Now that's not, remember, in the GFC, post GFC, new supply collapsed to like 150,000 units. We do not see that happening. That is not anywhere in what the data is telling us. So that depending on where you sit with that, that's either a good thing or a bad thing, but it's clearly a thing.
And it's interesting to note because we've had this kind of silent recession, look worse than the GFC, that
yes,
most people aren't really aware of, and trying to explain to investors, as the cap rates expand, that we've been in a recession for many years.
4 years. So the housing market really has been in a recession since interest rates spiked in 2022. That's just the fact of, and in multifamily, as the units in the Sun Belt began to deliver in 22, 23, 24. Right. So that's been the extended investment from an investor standpoint. Values have been sort of under pressure to a degree during that time period. Okay. And whether, obviously from the peak, they're down, but then kind of they've leveled. And now it's all based upon how much income growth you can manufacture, right, from your renewals, from ancillary income, from other elements that you can create. You can basically from a value add, to the extent you can do that. So your manufacturing returns on your own, you're not necessarily getting super tailwinds from the capital market conditions or overall. There's still meaningful opportunities to be had. Now, even in the other part of that is, even in a market that appears to be under pressure, there are wide divergences in submarket performance. Meaningfully divergence. And really, it's just a question of where the supply isn't and where affordability is. So we're seeing outsized performance in places that are sort of like more affordable in a metro area where that didn't get a lot of supply. So they're getting overflow, as it were, and they're getting a benefit. So that even within difficult markets, there are pockets of sort of NOI growth. Okay, and even in great markets, there are pockets that aren't doing well. So there's a market story, and I'll call it that's the general tide. But there are kind of shoals and flows and other places that you can overperform within any given market set of conditions. And so it is much more refined, much more nuanced than maybe had been in the past. It definitely requires a greater understanding of local market conditions. So there's returns to that, and it's much more, I would say, again, manufacturing returns or grinding out returns, much less overall momentum of a tide. So that's how I would characterize the current kind of set of market conditions. There is tremendous debt capital available. Like, debt capital is not a problem, right? You can get it at the rate that it's available. And then, you may not like that, but it's available. It's not like there's a capital shortage. It's just whether you like the pricing of it and the terms of it. And then on the equity side, there is equity capital available. There's no shortage of capital to do deals at the prices you would like to do the deal. Right? And then that becomes the I don't like the price, right? So there's not a capital shortage per se. It's basically maybe a price, a bid-ask spread that you can't close. And again, from the seller's perspective, unless they have to, then they don't have to, right? So there are situations where they're compelled to sell because they're out of fund, they're out of time, they have no choice, or they're at the end of the fund and they have to create a liquidity event. That does happen. And they will basically market to market, and whatever it is, because they got to close the fund out. But and then if somebody thinks that they're in the Midwest and they can get a great price because values have gone up, then they'll go with it. We also identified lots of properties that have 7 years of low price debt to run, where an assumption may make sense, right? And where value add opportunities do exist, again, in certain places. So there's opportunity, but you definitely have to be much more of a sharpshooter now than in the past.
Yeah, I do believe it's tremendous buying opportunity. We're seeing cap rates higher than we've seen in 10 years or so. But it's interesting because I think there's still the big capital that is still sitting on the sidelines. I think they're waiting for the bottom where we're probably pretty close to it, but yet they're still wanting higher cap rates or something before they deploy capital. I'm curious if you have a take on that.
Well, it's always the case that private capital, institutional capital, will always lag a little bit. It's just the incentive structure. The managers there don't really get paid to take over extended risk. So they'll tend to wait for a turn to be fully in evidence before getting behind it. And it's usually private capital, family offices that will decide that there's a bottom forming. I don't know exactly when that exact bottom will occur, but I know that if I wait for it to occur and validate, I will have missed it. Almost the same as stock market investing, right? You don't try to perfectly time the stock market because you'll never perfectly time it. What you're trying to do is get close and accept the fact that, yeah, you might have a rough quarter or two before things turn. But if you've got a good solid business plan and you're in place with good demand characteristics, you're going to do okay, right? But you're not going to perfectly time the bottom. And the fact of the matter is, unless you are truly in front of a distressed seller, you're always, the winner of a purchase, unless they're truly like off market. Well, you always paid more than everybody else. Otherwise, you didn't win the deal. Like that's almost like that's definitional, right? So, what did you believe that had to, that then other people didn't believe. You either have a cost of capital advantage, or you believe you some component of a cost advantage, or you have some other advantage that allow you to slightly outbid everybody else. I do think, again, there's opportunities for off-market deals to create your own opportunities, and sometimes that takes a bit of patience to basically hang around the net, build relationships with those sellers until the right time occurs, but you can never quite tell when that right time is going to be. But you have to have enough things going on that enough kind of things fall out. Yeah,
I'm curious, what markets do you think are best positioned for the next 3 to 5 years?
Well, we've identified, and it's in our webinar, a set of what we would call emerging markets that are mostly Midwestern based. There's the Kentucky markets in Kentucky and Southern Ohio, and Nebraska, Omaha. So these are markets that are kind of unloved, but they've got interesting things happening around them. Columbus and Kansas City are like the poster children of these, and they've gotten a little too much attention. Okay, but it's cities like that. Again, you can go to our website, yardimatrix.com, and you can download the webinar, and the list is all there. These are places have the conditions that the big Sunbelt markets had 15 years ago. They have a public policy consensus on the desirability of growth. They have affordability. They are trying to grow economically. They're beneficiaries of AI investment and reindustrialization, and so the jobs are going there. The people are following those jobs. I do believe in the resurgence of almost the entire Sun Belt, which is very politically, I'll call it, friendly to business. Okay, but I'm not too thrilled about Colorado, where I live, not because of the political environment is not conducive to economic growth, which will eventually absorb all the supply that's already here and provide the rising tide. But I'm very optimistic, maybe 3-4 years, that all the Sunbelt cities throughout the South, Southeast, Texas, they're going to do well because that's where the locus of economic growth is headed, right? And continues to head. And if you're really investing in multifamily, we support the economic growth of communities fundamentally, right? That's what we do. Will there be money to be made? Right now, Chicago is doing incredibly well because there's been not a lot of supply. There's been some decent growth, and the sort of the sort of the horrible situation, in the state of Illinois hasn't gotten so bad that people have fled en masse. Okay, so Boston's doing okay. New York at the very upper end is doing great, because all the other policies are so stupid that they're creating a housing shortage, which is inuring to the benefit of the extreme high end until the taxes get so onerous that people bail. Now, I'm from New York, and I've seen this show happen before, and there's a cycle to it. So this feels like Mayor Lindsay in the late 60s all over again, and it led to a disaster. And then, so I would say each of these disasters lead to an eventual incredible generational opportunity when the turn finally happens. And I would potentially argue that San Francisco, turned before the AI boom, when the new mayor came in and the people had finally had enough, right? And he's a businessman, and he's normal, and he's cleaning up the city, and he's doing normal things. And so when you have normal things, the recovery in San Francisco had already begun prior to the AI boom. The AI boom is merely adding sort of fuel to the fire, okay? But it was a political turn first. You're still seeing a sort of a spiral down in the city of Seattle, and we're not out of that yet, okay? So we do have what's intriguing here is not only do you have these economic forces, but you have the forces of political polarization, which move economic growth into business-friendly states, right? Which is really defined as the Sun Belt and most of the Mountain West. Idaho, Utah, Arizona, except in Colorado, and then you shift right. You skip over New Mexico because they don't like they don't like anybody, and then you skip over New Mexico, and then you go through you go to the southeast. You go to the southeast and kind of up, and then you kind of stop around Virginia. North Carolina is probably the top of that, but then you're getting a lot of red states in the Midwest, which are very conducive to economic growth. I tend to look for a public policy, private market and public policy consensus around the desirability of growth. Okay. And that usually drives early stage kind of performance. And you're looking to get in slightly ahead. But again, so that's a long kind of story to say the US is increasingly, it's not one story, right? It's not a story of universal growth. Okay. It's very, I'll call it specific to that particular society, and I call society, that region's kind of public-private market consensus around, do we want to grow? Are we investing in infrastructure to enable that growth to happen? That's kind of like how I kind of look at things, and I'm looking for those places that have those conditions. Okay, so you kind of and in those smaller markets, they're thinner. They're not going to have the kind of transaction volume. And there's early stage risk, right? Not all of them are going to make it. So having a diversified geographic portfolio does make a lot of sense because you never quite, is Lexington or Omaha going to make it? Well, they each have really interesting components. It's a little hard to say that all of them will make it, but many of them will. That leap to, bigger, and then usually the institutional capital follows. And then the cap rates in that city reset, right? It wasn't that many years ago that institutional investors and foreign investors would not go to Raleigh, would not go to Charlotte, would not go to Dallas at all. They simply said, we're not going to go there. It's risky. But the market is widening. And when the market widens, the valuations reset.
Okay, one last question for you.
Yes.
What's the single biggest risk you're watching over the next 24 months?
Wow. 24 months.
And if there's a longer time frame or whatnot.
Yeah, I mean, so I'm a bit of a student of Ray Dalio's. I think he really has a beeline into the larger forces shaping our societies and the global society. And his warning about where we are in this sort of larger cycle is pretty dire. He's like, hey guys, there's some real risks here. I genuinely think the biggest risks are at this point more political risk. And the reason I would say that is for multifamily investors, you're buying into a community and its consensus on growth, right? And when you want growth to occur, you don't want it to grow too fast because it blows it up, but you don't want it to not grow at all because it becomes stagnant, right? So you're looking for growth that is occurring, but not too fast that the region can't absorb it. And I think about this in infrastructure standpoints. That, in my mind, the biggest risk is you're going along through life, right? La di da di da, and then suddenly there is a sort of a view that the private ownership of housing is somehow evil and it's legislated out of existence, right? So, or you're in Washington or Oregon and California, and the rent control regime there is tolerable, right? It's got a carve out for 15 years. It's CPI plus 5. And you can say, I can kind of live with that. I mean, it's got vacancy decontrol. And you look at the piece and you say, it's not ideal, but I can live with it. Yeah. And I would say New York City in rent stabilized was like that until 2019. It really was. And how did you get that system? You got that system because the 70s, the rent control regime in New York in the 70s was so horrible, and I lived through it, that buildings were burnt down because they couldn't be maintained at all. It was better to burn them up and get the insurance money than try to run them. As a response to that, this sort of infrastructure regime was built that kind of like had these sort of safeguards and you could live with it. And in 2019, the public policy consensus around it collapsed. And the value of those properties is down 40 to 50%. and there is no exit. And then you have a further socialist who kind of says, I'm going to freeze the rent. I'm not freezing your costs, but I'm freezing the rent. Okay. Because I can. And there's no vacancy decontrol. So I can't even, there's no way I can do anything here. The rent control regimes along the West Coast are at the moment tolerable. They are. You could live with them until they're not. And so that's the risk is if you're going to invest in anywhere in Washington or Oregon or California, you have to understand that the regime is tolerable at the moment. So it's good until it's not. And you truly can't know when it goes bad because you're investing 5 to 7 to 10 years, right? And so you're projecting out in time that the world you see today will be the world that will be out into the future. And in those regimes, you can't really be sure. You think, and you should be honest with yourself and your investors, is that I better make money right now because there's a risk which I really can't quantify, right? There's quantifiable risk, and then there's I think I can't quite remember. There's risk and then there's uncertainty, right? So it's in the uncertainty bucket. There's a level of uncertainty that the whole thing goes to hell in a handbasket and you get wiped out, or everything works out fine. And again, I know a lot of folks in New York who made a pile of money in rent stabilized apartments from 1992 when Giuliani kind of came in and there was a consensus around growth all the way to 2019. It was a great trade. People made a ton of money doing that, right? Until it wasn't. So in my mind, that's the risk that is hard to deal with. Like we can look at expenses and rents and supply, and even we can postulate demand and the economy and jobs, and we can wrap our head around that, right? And you can kind of put fences around those exposures and you can make that bet, and it's a pretty good bet. I can't underwrite the political exposure in some of these places. I just can note that it's there, and and right now the probability of it blowing up is low, admittedly, but I can't know that for sure. So I better get paid for it, right? So that if it happens, I'm okay with whatever happens. Anyway, that would be the thing that, like, if you ask me, the thing that bothers me the most, that's the thing that bothers me the most.
Well, I mean, that's a good take. And certainly living here in LA, I mean, I know my friends certainly felt it during COVID when they restricted rent growth and rent growth and people
Right.
weren't paying
and collections, right? Right. Yeah.
Right.
And they're in certain pockets, like I think elements of downtown LA, you still have an overhang of that. You haven't fully gotten the fact that, hey, you actually have to pay what you owe. Surprise,
Well, Jeff, thank you so much for sharing your expertise with us. Where can listeners find out more to subscribe to Yardi Matrix and whatnot?
Well, thank you for the plug, Gary. If you go to www.yardimatrix.com, that's our public-facing website. We actually have a way for you to subscribe for free to our research publications. And if you like what you're seeing, you also have the opportunity to subscribe to our data service behind the paywall, which gives you a lot more data in terms of that drives investment decision making. Either way, we're just happy to provide an opportunity to the industry.
Awesome. Well, thank you so much. Appreciate you coming on. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.